As an investment researcher and a very curious person, I always heard the following phrase: don't trade margin unless you understand what it means. When reading about it through sources, I discovered the following quote: margin trading is a form of leverage trading that takes place from a margin brokerage account. With a margin account, the cash you deposit has the greater nominal buying power, as the brokerage will loan you the difference automatically or require that you post a smaller amount of collateral when placing a trade. Let's see more about how to use margin and why you need to understand what it means. To operate a margin account in forex trading, for example, you need to have a specific knowledge of what the margin percentage will be. Forex brokers may require a minimum deposit of money or assets to be used as collateral when placing a trade from a margin account. For example, if you have a balance of $10,000 and want to use it all to buy a forex pair that you were expecting to increase by 2% on the normal account, you can use the $10,000 as an 100% margin and target a profit of $200. However, from a margin account with a 50% margin requirement, you can buy the same quantity of currency that you did before with only $5,000 from your $10,000 balance. This is because the broker is putting up the other $5,000 behind the scenes. Lastly, any leverage obtained from a margin account is not free, as it has the interest to be paid to the broker when any positions are maintained for more than one day, usually past a specific time each day, generating rollover costs. All the features of margin accounts are designed to be useful for short periods and trading with a high level of certainty. Most stockbrokers don't allow margin operations with high-risk assets like over-the-counter products or penny stocks. However, with commodity and derivative trading as well as forex trading, it is almost always done from a margin account. That's why it is important to know what your margin requirement is and any levels that can trigger a margin call, also known as a liquidation call. It's when trades are closed automatically due to insufficient available balance. In some cases, a margin account can also cause a negative balance. Investors also say that generally a low margin requirement will mean a higher leverage, while a higher margin requirement will mean lower leverage. Here are some examples of various margin requirements and their associated leverage amounts. 100% margin equals 0 leverage. 50% margin equals 2 for 1 leverage. 55% margin equals 4 for 1 leverage. 50% margin equals 5 for 1 leverage. 10% margin equals 10 for 1 leverage. 5% margin equals 20 for 1 leverage. 1% margin equals 100 for 1 leverage. If you like this video, follow us on our social networks at Investpage and subscribe to this channel. See you next time.